So there's a lot of activity, a lot of repositioning. Net flows have been offset really by GBTC as people are unwinding the arbitrage and stuff like that. So I don't think you need to read much into it. It probably has to digest. Don't forget, you brought forward a lot of demand. Net, what will have we brought forward? $2-3 billion of demand. Okay, so that takes time for the market to digest. And then you've got to think through who the RIAs are, who these people are. And if you put them in your head, these are not New York dealing rooms who are getting on the phone and saying, buy this now. They're people who are wearing slacks, who read Barron's on the weekend, read about the ETF, aren't sure, go on the golf course, see their best client. He asks them a question. The whole process is slow. They've got to go and have steak dinners and all of that stuff. So the whole process of bringing people in is going to take a while longer, but it's there now. I just think of the ETF as a trade deal between fiat world and crypto land. And so now capital can flow in much easier than it used to. I kind of think of this as a mental model as like China entering the WTO when everybody could invest in China. That's what this is. Now, these aren't permanent residents in crypto land. This is more hot money flows, tourism flows, hot money flows, direct investment, foreign direct investment, that's VC flows. And then we've got a bunch of residents there, people who have wallets and all of that. So I do think of it as an economy, and this just allows trade. So if you think about the biggest buyers of this stuff is actually the millennial cohort. What the millennials do really well is they invest in their 401ks every month. And they can put this in their 401ks. So that's sticky. That's why ARK didn't get all the redemptions when it went down 75%. It's because it's millennials who own it and they put it in their 401k and they're in it for the long ride. So I think it's the boomer crowd who'll be more concerned about the volatility. I think that's a very good thing. There's going to be a lot of people putting it as a long-term asset, buy and hold, and that should give it the stability that you need, that you don't just get massive washouts from people panicking the moment it goes down. And I think most of the ETF providers have made it pretty clear that it's a volatile asset and it's a buy and hold asset. I think as assets mature, they become less volatile. So I think we need to expect that. And particularly from passive flows of 401k investors putting it in every 2 weeks, every month, that'll keep a bid that didn't exist before. So I think, yes, we'll probably see lower volatility, but we'll also be feeding capital into crypto land, and crypto land's not just the state of Bitcoin, it's a whole bunch of other places that are going to see capital flows. So the Wild West will still exist, but the big daddy becomes less volatile, yes, it's a shame because we can't make as much money out of each cycle. But if our underlying philosophy is we want the adoption of this technology to be broad and deep, it has to go that way. So it's kind of good from that philosophical angle of trying to change the world, bad from the ridiculousness of the cycles and how profitable they can be if you get them right. So how I'm thinking about it, I'm giving a 60% probability this is a relatively normal cycle, in which case it would get to 150,000, let's say. I'm giving a 20% chance that it's actually a front-loaded cycle because of the ETF and other stuff, that maybe it gets to that 150 faster and then fades, which will be kind of pain for a lot of people who expect it to go into 2025, right? And then the other 20% chance, I think, is that this ends up being a bubble cycle. And so it looks more like 2011, 12, 13 than it does the previous one. And in which case, if you remember that cycle, it had a interim top correction, everyone thought it was over, and then it just exploded again. I think there's a decent chance of that, but we need to see the contextualization of how the ETF flows impact, what's happening with monetary policy, what's going on in the economy, how the election's going to play into this. So that's how I'm thinking of it. That upside crazy bubble target, using that kind of everything code structure that I've talked about in the past, we get price targets of 500,000 plus. So even if I discount me for being a moron by 50%, you still get 250 grand. So that's kind of the spread to me, 150, 250. But obviously who the hell knows? And as you know, the worst thing for any of us is everybody wants price targets, and then a year and a half's time they hate you for it because you weren't exactly right. Think about the crowd that got financialized in 2020. Again, mainly the millennial crowd, right? There's 110 million Coinbase accounts. And when I checked 6 months ago, only 9 million were active. So speaking to the guys at Coinbase, they're like, yeah, in normal activity, it'll get to 35, 40 million and the top will grow as well. So there's a lot of money still to come in of people who participated last time around, have that interest, still have PTSD, will come back in. So maybe that offsets it. I don't know. I also have a feeling the applications layer of blockchain is going to bring in a lot more use case. So I'm thinking of this cycle as maybe the everything everywhere all at one cycle, when people have different unlocks for NFTs or inscriptions or different unlocks for smart contracts and some of the other things, and they can use it for everything from whether it's ticketing to real world assets. So it just depends how far that applications layer goes. If the applications layer doesn't make much progress this cycle, then you're dead right. We'll see rebalancing. Don't forget, they're also going to be issuing options on the ETF, and that changes the structure of markets as well. What you've done, and it was always going to happen, is Bitcoin's now become financialized when it wasn't really. It was still had purity to it. Now, it doesn't mean it's impure because of this, but you've allowed a financialization layer. And what that's going to mean is that they are going to offer leveraged products on it. Now, options are kind of defined risk products, but what you end up with is, in a very high volatility product, we get a lot of volatility sellers, and it dampens the market because they're always hedging, and that hedging structure can really change the nature of markets. Sometimes it creates acceleration points because everybody's short and suddenly the price goes through and everyone has to buy everything back. Other times, just by the ongoing selling of yield, selling of premium for yield, it slows down the whole market itself. So I do think that's a bigger deal than people expect. But the casino for options on ETFs is going to be quite amusing for a while as well, because if you think about how much the Robin Hood crowd use options on tech stocks, they're going to go wild on this stuff, and they've not been able to. For Americans, it was really hard. Deribit was not accessible to Americans. They're now going to start using options. I don't know when that launches, but it'll happen at some point. And that brings in all the market making firms and the investment banks and all of these other financial players.